Hi, everyone. So, welcome to another episode on the Business Leaders Show as we focus on the IFRSs and the various accounting standards that we need to focus on in order for us to increase our chances of passing the examination. I see some of you guys joining the stream. You are welcome to the stream. This is the third episode as we look at the various key accounting standards that we need to focus on to be able to pass the examination. In the first session, we looked at definitely the overview of the various standards and how we need to learn the standards together. In case you missed that video, you can check the description of this video. You can watch that. And then we looked at the IAS2. We did share our thoughts on how IAS2 is done accounting or inventories. And then we looked at IFRS 5 yesterday, non-current asset held for sale and discontinued operation. That is very critical, very basic. And today we want to go into two of the key accounting standards that we need to understand relating to the preparation and presentation of financial statements in that particular case, relating to the preparation and presentation of financial statements. Give me a moment. Okay, so we want to look at these two basic accounting standards, and that is going to be IAS 8, accounting policies, changes in accounting estimates and errors. And then we'll look at the grandpapa of all accounting standards, and that is going to be the issue about IAS 16, property, plant, and equipment. I see some of you guys joining. Comment in the comment section in the chat box. Any questions you have for me, something you would want me to share my thought on, put it in the chat for me. I see some comments coming in. Let's see if we can address them real quick. Sharon said, what? Good evening, sir. Good evening, Sharon. Hope you're doing well. Who do we have? Osumanu said, hi, Nhyira from Winneba. Hello, Osumanu. I hope that you're doing well. Thanks for joining us. Amadou Abdul said, good evening, sir. I like your watch. Oh, that's an Apple Watch. So thank you very much for that. Then Tom Ford said, is the FR what? I don't know. FR what are you asking? There's a symbol there, but I can't see that. Edu Juma said, thanks, Nhyira. Always a pleasure. Edu, and welcome to the live stream. So in case you've not subscribed, make sure you hit the subscribe button. Let's get excited about it. Let me know, where are you watching us from? What are some things you would want me to pretty share my thought on as we move on with the discussion? Okay, Ato Forsen said books. No, our FR books are not still in. We still having problem. There are a number of holdups relating to the books. So not only our stocks, but then this is happening across the US, and that's where I do my books. So either the US or the UK, but this time around we worked in the US, so it's delaying the stocks a little bit. So for now, it's still not in, but when it is in, you will be notified about it. Momba said, hi, Nhyira. Hello, Momba. Welcome. Adolfo Chua said, hi, from Liberia. Thank you for joining us, Adolfos. Favor Sharon Stone said, sir, please, do you have this live stream on Saturdays and Sundays? Currently, we don't do any live stream sessions on Saturdays and Sundays, but we're thinking about it, whether it is something we would have to do, where we will dedicate these or those sessions to probably solving some questions on specific issues or broader scope of the syllabus. So I don't know if it is something you guys will be excited about. Let me know in the comment section in the chat box. Maybe we could arrange some sessions on Saturdays and Sundays in that regard. But Sharon Stone, you are a student learning financial reporting, I think so. You have enrolled in our full course and you are learning from us from the 12th of how do we call it? February 2022. We're going to be starting with our executive revision masterclass, and that will be on Saturdays and Sundays, I think around 6:30 or 7 p.m. also in that manner. So from 12th of February, since you are part of our students, when we start with our executive revision masterclass, you're going to have the Saturday and Sunday session, and that will be on Zoom. That will not be a live stream that is available to the public in that case. So that's it about that, Sharon. Muhammad said, good evening, sir, from Nigeria. Happy to be with you live. Awesome to have you, Muhammad. Thanks very much for joining us. Give us a thumbs up on the video, guys. Give us a thumbs up on the video. It helps us a lot to reach a lot of students, and YouTube will be able to then push the video so we can reach a lot of students. So give us a thumbs up on the video. It's really, really help us a lot. Sharon said, please, sir, do you have notes for the accounting standards aside the live stream sessions you have on accounting standards? Yes, Sharon, I don't know. I've forgotten the course you enrolled in though, but if you are enrolling in financial reporting, then on our study portal, you have lecture videos there on all of the standards, and the ebook and question kits are available as well on the study portal. So I think you should have access to that, because our notes, our ebooks, our question kits are available on the study portal once you enroll in the full course. So Sharon, you should have access to that as per my thinking if you have enrolled in financial reporting there. Awofe said, what, Master, I do enjoy your lectures. More knowledge to you. Thank you very much, Awofe, for joining us on the live stream as we go ahead with our discussion today. So let's get straight up into our discussion. IAS 8, accounting policies, changes in accounting estimates and errors. Then we will go to IAS 12, property, plants and equipment. Very, very critical, very, very pump up. So let's get excited about it. If there are any questions, you know what to do. Put them in the comment section, put them in the chat. I'm going to be answering all of your questions for you as we proceed with our discussion today. Sharon said, it doesn't have notes attached. I don't understand what you mean by it doesn't have notes attached. If you are enrolling in our courses online, there are ebooks, there are question kits available. The ebooks are the notes. So I don't know what notes you are referring to again, though, but the ebooks are the notes for the manual. And if you are doing financial reporting, we have a new ebook available, which is the 2021 ebook, which focuses on key issues that we have been using during our discussion. So if there is anything that should be available to you, because it's available to everybody. Stanobi said, good evening, Shira. Good evening, Stan. I hope you're doing well. Thanks for joining us on the live stream today. Okay, so let's go straight up into our discussion. Are these beautiful lessons recorded? Are you referring to this live stream we are having? If there's this live stream, yeah, definitely it's recorded. It's available on YouTube after the live stream. Then our main courses also on Zoom. That is also recorded and available on our study portal for further coverage by students in that manner. So let's go straight up into our discussion for the day. And let's start with IAS 8, accounting policies, changes in accounting estimates and errors. Let's go on that. So IAS 8. Now, it is very important for us to understand that, now this is accounting policies, changes in accounting estimates and errors. It is very important for you to understand that when we are dealing with the preparation of financial statements, there are going to be various assumptions that we have to use in the preparation and the presentation of the financial statements. These assumptions used by the management and the preparers of the financial statement must be founded on basic principles and basic concepts. Now, the principles, the concepts that governs how these assumptions that this judgment that management makes are going to be founded on reasonable grounds is what is guided in IAS 8, accounting policies, changes in accounting estimates and errors. Now, off the bed, what I want to say is that what it means is that this is divided into three. We have what we call the accounting policies. We have what we call the accounting estimates. And then we have what we call the errors. Errors. Now, note that the accounting policies and accounting estimates are all the various things that management uses in the preparation of the financial statement, but we're going to get into it much quickly. The accounting policy are the generally the principles, the rules, the guidelines that an entity adopts in the preparation and presentation of its financial statement. So I'm going to bring up my slide, and then we're going to be taking some one-liner definitions from here to bring our discussion home. So when we say accounting policies, what do we mean? When we say accounting policies, what do we mean? So accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements, period. So when we say the accounting policies of the company, what we are referring to is what are the rules, what are the principles, what are the conventions, what are the practices that an entity has adopted and it's applying in the preparation and presentation of financial statement. That is what we mean by the accounting policies. But the big question we ask ourselves is, what are some examples of accounting policies that we must pay attention to and be well aware of? So examples of accounting policies include the following. Now, off the bat, you must understand and know the examples of accounting policies, because the broader scope of this discussion is to find out how to deal with changes in accounting estimates. And we're going to get there. So when we get to dealing with changes in accounting estimates, that is going to be more interesting than where we are now. But follow me carefully. So what are some examples of accounting policies? So when we say an entity is using an accounting policy, what are some examples? One, valuation of inventories using either the FIFO method, either the average cost method, that is simple average, or any other suitable method as per IAS 2. That is an accounting policy. So the way an entity values its inventories is not based on judgments, it's based on a policy. So the entity can adopt or use the first in, first out approach, that is the FIFO, or the entity can use any approach as per the IAS 2. And according to the IAS 2, inventory should be valued at full factory cost. Okay, inventory should be valued at full factory cost. Now, for those of you doing management accounting, definitely you will understand this principle much better than the people who are doing only financial reporting, but you get there, definitely. So when we are determining the cost of inventory, it's going to be what? The full factory cost. In other words, the direct material cost is going to be coming in. We're going to bring the direct material cost, the direct labor cost, the direct expenses we incur in the manufacturing of the inventories. We add all these up. That gives us the prime cost. Then we add the factory overheads. So it means we are using the absorption costing. That is why if you are doing management accounting, we say that absorption costing is a preferred way of absorbing overheads. Why? Because under the absorption costing, inventory is valued at full factory cost. And that is supported by IAS 2 inventories. So the method of valuation of inventory is an accounting policy. 2, classification, preparation, measurement of financial assets and liabilities under IFRS 2 is also an accounting policy. What does that mean? Now, we will get into this much later on, but let's say, for instance, an entity buys a financial instrument. So let's say an entity buys shares in another company. Now, the entity can classify that share. Yeah, the share is an equity investment though, but then the entity has 2 ways that it can decide to classify or categorize the shares that it has bought. It could classify it at fair value through P&L, okay, or classify at fair value through OCI. And there are various criteria that must be met for this classification. So the way an entity classify or categorize its financial asset and financial liability is also an accounting policy. Does that make sense? It's also an accounting policy. Like I said, we will look at this much later on when we are discussing IFRS 9, financial instruments, how we deal with these items generally in that case. Then, timing of recognition of assets, liabilities, expenses, and income. So when do we recognize assets? When do we recognize liabilities? When do we recognize expenses? When do we recognize income? Are all accounting policies. And this is where the standards are going to be coming in, because the standards prescribe the timing and when certain items are supposed to be recognized. For instance, if you are dealing with revenue, we know when we can recognize revenue, and that is if a performance obligation is what? Satisfied. So when we are able to satisfy a performance obligation, then we can recognize revenue. That is an accounting policy, and that is a guide provided by IFRS 15, non-current asset held for sale and discontinued operation. So the timing and when assets, liabilities, and or income are recognized is also going to be something very, very critical in that case. Next one. The basis of measurement of non-current assets. Be careful here. Be very careful here. The basis of measurement of non-current assets. So for instance, if we are using the historical cost or the revaluation basis, this is an accounting policy. This is an accounting policy. So the basis of measurement of non-current assets, be it a property, plant, and equipment, be it an investment property, or be it a leased property of an entity, the measurement basis that an entity will use or available for use will either be either the historical cost or the revaluation basis. And again, we will expand on this much later on when we are looking at IAS 16 property, plant, and equipment, because really IAS 16 property, plant, and equipment shares light on how we carry assets either at the historical cost and or at the revaluation basis. That is also an accounting policy. Then certainly the preparation of financial statements on the accrual basis is also an accounting policy that an entity can use. So what are we saying? When we are talking about the rules, the principles, the conventions, the practices that an entity applies in the preparation of its financial statements, then we are referring to what? The accounting policies. The accounting policies. Now, I am not excited about the definition of accounting policies as much as I'm excited about the examples. Because the crux of the issue on this particular standard is your ability to identify whether this thing is a change in accounting policy or it's a change in accounting estimate. Because if you screw it up and you are not able to distinguish between a change in accounting policy and a change in accounting estimate, then that is going to be affecting the way you account for it generally or ultimately. That's going to affect the way you account for it generally or ultimately. Now, I see some of you guys joining. You are welcome. Comment in the chat box or in the comment section on Facebook if there are any questions you have for me or something you want clarity on. But remember to give us a thumbs up on the video. It helps us a lot to reach a lot of students. And that is how we are able to grow the community so we can help a lot of people just like yourself. So if you're getting some value, smash the like button. Consider to also share the video with others. Now, one thing you must understand is that one of the qualitative characteristics of financial statements, is comparability. And this is an enhancing qualitative characteristics of financial statements. It's not fundamental. The fundamental qualitative characteristics of financial statements are relevance and then faithful representation. But then the enhancing qualitative characteristics of financial statements, one of them is comparability. And to enhance comparability of financial statements, there has to be consistency in the application of accounting standard. To enhance comparability of financial statements, there has to be consistency in the application of the accounting standard. As such, IA8 states that an entity must use or must be consistent in the application of its accounting standards. The entity must be consistent in the application of its accounting standards. And that is very, very important. That's very, very important. Then the second thing that we need to know about is, now before we come to accounting estimates, definitely, is prior period errors. Prior period errors. Remember, it's one of the elements in the whole discussion of IAS 8, and that is prior period errors. So when we say prior period errors, listen to the name prior period errors, meaning that error that was committed in the past but was identified today or was identified in the current year or during the preparation of the current financial statement or during the preparation of the current financial statement. So prior period errors are omissions from and misstatement in an entity's financial statement for one or more period arising from a failure to use or misuse of reliable information that was available and could reasonably be expected to have been obtained and considered in preparing those financial statements. So when we say prior period errors, a number of things you must understand. It is about omission, like you did not recall the thing at all. That is one level of prior period errors that we need to understand. Or number two, it's about misstatement. You stated it correctly, but then you did not state it correctly. In that case, it becomes a misstatement that you need to also understand. Or it could also be maybe the fact that you were not having or you did not discover certain information as at the time you are preparing the financial statement. Now, the big question we need to ask ourselves is, how are they done? Now, since it relates to the prior period year, it means that they will be applied retrospectively. So there is what is called retrospective application for prior period errors. There is now, when we say retrospective application, what does that mean? It means because it relates to previous years, it means the financial statement of the previous years must be what? Adjusted. For that reason, your opening balances would need an adjustment. Your opening balances would need an adjustment. So for instance, let's say you are in the current year, which is whatever. Let's say you are in 2020. That's our current year. And then we identify that the entity did not charge or undercharge depreciation in, say, 2018 or in, say, 2019, just the previous accounting year. We realize that the entity undercharged depreciation. Okay, what are we going to do? What we're going to do is that if depreciation was not charged, depreciation is a profit or loss issue as well as the statement of financial position issue. It means that profits had been overstated. The charging of the depreciation that was less charged means profit was overstated. So that means our retained earnings brought forward must be adjusted. Okay, so the retained earnings require some adjustments that we need to look out for. So we're going to be doing that error on the opening retained earnings figure. That is what we mean by retrospective application. Are you getting it? And we're going to be expanding on that in a moment. Then the assets, because depreciation was less charged, it means the asset figure was also what? Overstated. So when it comes to the non-current assets of the company, since we are charging depreciation, maybe it's a property, plant, and equipment. Remember, depreciation can also be charged on investment properties. We will get into that later on under IAS 40, because depreciation can be charged also on investment properties. So in that case, what it means is that the carrying amount of the carrying amount, CA, of PPE is overstated. So what does that mean? It means the PPEs also needs an adjustment in that case. So when we say retrospective application, it's not just about going to the last year's financial statement and trying to prepare the whole financial statement all together. Sometimes it is just about adjusting the opening figures that you brought up to take into consideration the errors that has been identified in the current year, which relates to the previous accounting year. So that is also the second thing that we need to understand. So we have spoken about accounting policies and then the prior period errors. Any questions, please? Any questions, please? If you have any questions, you put it in the chat. For those of you on YouTube, and then if you're on Facebook, you can put it in the comment section, and we can hear from you. Eric Ahiadeki, Abubakar Sulemana, Humfred Ashikwe, and Ato Tom Ford. Thank you very much for the thumbs up and the love on the video on Facebook. Thank you very much. And for those of you who have given us a thumbs up on YouTube too, thank you very much. In case you have not, smash the thumbs up button, click on it, let it turn white for you there so that we know what you must do in that case. Okay, let's move on. Let's move on. So if an entity is selecting an accounting standard, what are some of the an accounting policy, what are some of the guidelines that the entity must follow? Now, this is just a brief theory that the examiner could throw at you in that case. Now, usually we expect that definitely an entity in making decision about accounting policies should refer to the conceptual framework of the International Accounting Standard Board, and also make references to the various IFRSs that has been issued in order to prescribe the accounting treatment or the accounting policy to be applied in the preparation of the financial statements. However, not everything is covered in the accounting standards. So in practice, you will realize that, or as you move on, you will realize that there are certain events that happens in practice which no standard is available for it. In such cases, management will have to exercise professional judgment. But then what should guide management when exercising such professional judgment? What are the key things that must guide management when exercising such professional judgment? So in making that judgment, management must refer to and consider the applicability of the following sources in descending order. So number one, the requirements and guidelines in the Iasb and its interpretation. So is there any other standard that we can apply to this particular thing? Is there any standard that we can apply to this particular thing? If there is any standard that we can apply, fine. Because sometimes you are dealing with a scenario that is not applicable in the standard itself, but there are other standards that actually covers it. In that case, then you will be able to have an understanding of exactly what is going on there. Or the definition, recognition, criteria, and measurement concepts in the International Accounting Standard Board framework. In the International Accounting Standard Board framework. So that is the issue we need to understand. When selecting an accounting policy for a company, the first place to go is to ask, what are the standards applicable? Okay, if there are no standards and we have to make professional judgments, are there any interpretations available? Or then we can refer to the International Accounting Standard Board conceptual framework for general purpose financial statements. So that is the thing we need to understand when we talk about how we select accounting policies. We've already spoken about the consistency of accounting policies. In that case, we've already spoken about how consistent our accounting policies are supposed to be. So we're not going to be looking at that. But this is the crux of the matter. Changes in accounting policies. So changes in accounting policies. Changes in accounting policies. So when we say a change in accounting policies or a policy, like what are we talking about? What are we driving at? What is the end goal in all this? So let's look at it. Let's look at it. There are only two circumstances under which an entity can change an accounting policy. Now, remember, I gave you the examples of what we mean by accounting policies a moment ago. Let's see. Let me take a screenshot of that and then bring it up. so that I explain to you well what's going on about changes in accounting policies. So I'm picking a screenshot of that, then I'll bring it into my bigger slide here on my empty canvas here. Okay, so let's go. Let's go. We have stated that the following are accounting policies. One of the things that are going to be critical will be the issue about the classification, the presentation, and measurement of things in the financial statements. So, for instance, let me explain this to you very well. Let's say that previously an entity charges depreciation on plants, okay? And the depreciation on plants, by default, plants relates to manufacturing of an asset. So it is expected that plants should be classified as part of the cost of sales of the company. It is for this reason why most of the time when you're preparing the financial statement or the final account, you realize that depreciation on plants is cost of sales. Then depreciation on maybe delivery van, ideally supposed to be under selling and distribution costs. That is the thing. That is the default classification. But can the entity change how they classify these expenses? Yes, they can. Yes, they can if they want to change it. So if an entity decides to change it, when can they change it? Two circumstances under which a change in accounting policy can be made. Only two. Only two. Number one, that there is a new accounting standard issued by. So number one is it is required by a standard or an interpretation. So there is a new accounting standard that has been issued that now tells us that our previous classification is wrong. Or there has been an interpretation by the International Accounting Standard Board, which now validates that the classification we were doing was wrong. So if there is a new accounting standard or there is an interpretation, then the entity can change the policy it uses in the classification, in the measurement, in the recognition of items or elements in the financial statements. But the second one is free bonto. Free bonto in the sense that an entity can change accounting policies if, in the professional judgment of management, the change will provide reliable and more relevant information about the transaction. So if the entity realizes that we need to change, because when we change, it will provide us with a better understanding, it will provide us with more relevance, and it will help us to really prepare the financial statement and let the financial statement reflect its status, then they will go for that at the end of the day. So let's say, for instance, like I mentioned, an entity uses or classifies depreciation on plants under cost of sales. If for some reason management decides that depreciation should be charged to administration rather than being charged to cost of sales, for that reason, the depreciation should now be classified as an administration expenses. Immediately management makes such a decision, that will be referred to as what? A change in accounting policy. That's what we're talking about. It is a change in accounting policy. Remember, probably there is no standard, no new standard that is making management to decide this. But management feels that when they now recognize depreciation on plant as part of admin expenses, it will provide shareholders, it will provide users of the financial statement with more relevant and reliable information for them to make their various decisions or the various decisions that they have to make. That is the issue about that. That is the issue about that. That is the issue about that. Any questions, please put it in the chat. Or an entity has an asset And since the time the entity bought the asset, the entity had been accounting for the asset or measuring the asset using the historical cost. So even though they can revalue the asset every year, they kept using the historical cost. Then after whatever, let's say 2 years, 3 years, 5 years, the entity now says, oh, to really enhance the financial statement and to let the financial statement reflect the fair value of the company, all assets should now be carried using the revaluation model. All assets should be carried using the revaluation model. When an entity does this, this is a change in accounting policy as well. Okay? This is a change in accounting policy as well. But a key thing we ask ourselves is, okay, if cost of sales, if depreciation on plant is now taken to admin, and we are changing the accounting for an asset at historical cost to a revaluation basis or module, how do we apply it? How does it work? A change in accounting policy is applied retrospectively. So a change in accounting policies is applied retrospectively. Why are we doing that? So that we will go back, meaning that it affects previous years. It affects previous years and the current year financial statement. That's what we mean by retrospective application. Okay, that's what we mean by retrospective application. It affects the previous year financial statements and the current year financial statement. But why do we do this? We do this because of the principle of comparability we mentioned a moment ago. So that the financial statement can be what? Compared. So we're going to pretend and say that even though the change is occurring this year, even though the entity is now deciding that cost of sales should be accounted for as an admin expenses, or all assets that are being measured at historical cost should now be measured at a revaluation basis, even though it is this year the company is deciding it, we will pretend as though the method has been there all along. Hence, we will adjust the previous year financial statement and adjust the current year and apply it to the current year financial statement as well. That is what we mean by the application of changes in accounting policies. The application of changes in accounting policies. That is very, very important and very, very critical. Any questions, please? Any questions for me? Any questions for me, please? Any questions for me, please? Any questions for me, please? So that is the issue there. That is the issue there. That is the issue there. But keyword, how far is too far? When we say the change in accounting policy should affect the current year financial statement and previous year financial statement, how far is too far? That one will be based on the professional judgment of the entity. The entity can go just 1 year, or the entity can go maybe just 2 years in that case. However, please note, sometimes if it is impractical for the entity to do retrospective application, then a change in accounting policy will be applied prospectively. Let's take that again, because it is important. Where it is impractical to apply, accounting policies retrospectively, it should be applied prospectively. It should be applied prospectively. So that is a note you need to understand very, very well. So where it is impractical to apply a change in accounting policy, a change in accounting policy retrospectively, management can apply the change prospectively. What does that mean? It means you won't go and adjust the previous year financial statement. That's what we are saying here. You will not go and adjust the previous year financial statements. You will not go. Now, how is that possible? Maybe it is a new company. So circumstances under which this will be done. This may be done. Maybe it's a new firm. So it's a new entity. And the first time we prepare a financial statement was last year. So maybe last year we used the historical basis. This year, so we are now trying to see which accounting policy will be suitable for us. So in that case, we will have to have different bases of accounting coming in. So usually if it's a new firm, the entity may want to apply a couple of different accounting policies, usually at the initial stages of the business, before it now selects what will be best for it at the end of the day. Are you getting it? So if it's a new business, sometimes it's going to be happening there. Then if the retrospective application is impractical, maybe it will require a lot of work, it will require a lot of resources, of which the entity is not willing to invest in because they would have to focus on other aspects of the organization, then they will not apply it in that case. But let's broadly look at how the standard lists some of the conditions down. So one, retrospective application of a change in accounting policy may be exempted in the following circumstances. One, a change in accounting policy is required by a new IFRS or an existing IFRS, and the transitional provisions of those standards allow or require prospective application. That's the thing. That's the thing. Because sometimes when a new accounting standard is issued, not sometimes, all accounting standards that are issued, there is what is called transitional provisions. Meaning, how, if you adopt this new IFRS, how you should apply it from your existing system to the new one. So sometimes in the transitional provisions, the standard can state that an entity can apply this retrospectively or prospectively. So if the standard in its transitional provision states that you can choose to do prospective or retrospective, then the entity can decide where it is good at, and they follow it. And they follow it in that case. Two, the application of new accounting policy in respect of transactions, events, and circumstances different from those that transpired in the past. So if the transaction we are referring to now had never happened in the past, then applying it retrospectively will not make any sense generally. Will not make any sense generally. For that reason, we may decide not to do any retrospective application. Let me give you an example of that. Let's say you apply IFRS 9, financial instruments. One of the key aspects of IFRS 9 financial instruments is what is called hedge accounting. And hedge accounting arises because the entity is hedging itself against derivative financial instruments. So maybe in the company's entire life, the company has been in existence for, say, 5 years. So the company has been in existence for, say, 5 years. If the entity has been in existence for, say, 5 years, and this is the first time the entity decides to buy goods from outside. So let's say for the first time, the entity decides to buy goods from China. Now, if the entity decides to buy goods from China, it needs to make payments in dollars. But then here we are in Ghana, payment that has to be made in dollars, we are using the Ghana cedis. So what is going to be happening? What is going to happen is that the company needs to convert its Ghana cedis into the dollar. Now, if the company waits to convert new Ghana cedi to the dollar, what is going to be happening is that there is going to be a negative movement in the exchange rate, especially the way our Ghana cedi is doing. So what a company can do is that the company can do a hedging techniques by investing or buying some features or options or even doing currency swaps or goods swaps. Now, what is going to be happening under this circumstance? This is the first time the company is doing it. So if this is the first time the company is doing it, then this is the first time the company is going to be adopting hedge accounting under IFRS 19. So even though it is because it's the first time, you can't go back to the previous year, the 5 years they've existed, to go and adjust anything there, because this is the first time the company is faced with such a circumstance in which it must adopt the hedge accounting technique. That is the thing about the third circumstance under which an entity can apply that, or the second circumstance under which an entity can apply that. So if it is something that is new to the company and does not have anything in the past, then this rule is going to be applying. The number 3, the effect of retrospective application of the change in accounting policy is immaterial. Okay, so this is where, remember, materiality is also about professional judgment of the organization. Materiality is about professional judgment of the organization. So maybe management sits down and decides that this thing is not really a big deal. Okay, like it won't change the various aspects of the organization. It won't change how we run our organization. It won't change the way financial statements will be faithfully represented. If that is the case, who cares? Let's just let it go. So if it is immaterial in the judgment of the organization or of preparation of financial statement by the directors of the company, then they will let it slide in that case. Then the last one is if retrospective application is impracticable, meaning it's not possible to do that, it's too expensive for us to do that, or it's too challenging for us to do that. Under these circumstances, we are saying that even though a change in accounting policy should be applied retrospectively, an entity will rather apply it prospectively. Are they breaking the laws? No. But it is because of the circumstances that they are faced in. And that is what you need to understand when we talk about changes in accounting policy. Changes in accounting policies. So what is the takeaway we've had so far? The takeaway we've had so far is that, hey, number 1, an accounting policy is, an accounting policy is a principle, a rule, or a convention that an entity uses in the preparation of the financial statements. Okay. If that is the case, what are the examples of the accounting policies? We've identified some of them. But the issue is, if the entity changes the accounting policies, how do we apply these? We are saying that by default, a change in accounting policy should be applied retrospectively, meaning to the current year financial statement and the previous year financial statement. However, we are saying that not all circumstances will a change in accounting policy be applied retrospectively. There are certain circumstances a change will be applied prospectively, meaning it affects current year financial statement and future financial statement, and the circumstances are what we have run through in that case. Then the final part, changes in accounting estimates. Let's talk about that real quick. So whilst the policies are set, management doesn't have control over it. They are set down by the conceptual framework of the International Accounting Standard Board, or they are set up by the IFRSs that has been issued, or the IASs that are available. So the accounting policies are set like that. But the estimates are where management has to make judgments about things which are not covered in the standard. So anything that is not covered in the standard, which will require management to make professional judgment or will exercise its judgment, is referred to as an estimate. Okay, it refers to as an estimate. So let's look at accounting estimate. I have a one-liner definition here for you. We say that an accounting estimate is an approximation of the amount of a business transaction for which there is keyword no precise means of measurement. That's the takeaway I want you to have. That when you think about accounting estimates, it is the determination, the approximation of the amount of an item for which there is no precise means of measurement. So anything that doesn't have a precise means, as per the conceptual framework or as per the accounting standard, management must exercise what is called estimates. So for example, so these are a number of examples of accounting estimates. For instance, allowances for doubtful accounts, or what you know as provision for bad debts. What we know as provision for bad debts. Now, certainly there are certain debts that are going to be not good for the organization. So according to prudence concept, as part of the basis of preparation of financial statements, management must make provision for future losses. And part of the future losses is provision for bad debts. Now, what rate do you use? Is it 2%, 1%, 5%, 50%? What percentage do you use? That is not established in any accounting standard. So there is no precise means of determining the amount of provision for bad debt that an entity can provide or that can make. For that reason, management is going to exercise their professional judgment. So that is the first thing: allowances for doubtful accounts or provisions for bad debts. Then work in progress inventories. Work in progress inventories, warranties or warranty obligations. Now, note, this is partly covered under IAS 37, provisions, contingent liabilities, and contingent assets. However, the determination of the amount is based on judgment. So, for instance, if an entity sells goods, and we will do this under IAS 37, there is what is called constructive obligation, and there is what is also called obligation based on the past activities of the organization. Hence, the entity would decide, okay, based on past behavior, when we sell 100 or when we sell to 100 customers, 2 of them return the goods so we can replace for them. So in that case, when we are making provision for warranties, then we will make provision for what? 2 customers. This is based on historical information. So there is no precise way of determining that amount. So management is going to be exercising its judgment. Then the method of depreciation and the useful life of the asset. You cannot establish a method of depreciation of assets. It will be based on the judgment of the company. So the company can decide we want to use the straight line method, we want to use the reducing balance method of an asset. Now, even though, as per the conceptual framework, assets such as equipment, assets such as plants, because their productivity reduces as they age, and they are supposed to be depreciated using the reducing balance method. So that assets of permanent nature, like building, office furniture, and other infrastructure, should be depreciated using the straight line method. An entity can decide to cross path. Why? Because with the day we are in now, with advancement in technology, you could have an old equipment and just change a part of that equipment, maybe the engine, or do a little overhaul of the equipment, and the equipment is now more productive even than a new one. So the method of depreciation and then the useful life of an asset. One entity will buy an asset and say, we will use it for 10 years. Another entity will buy that same asset and say, we will use it for 5 years. So that is also based on the judgment of management. Then fair value of goodwill and other intangible asset. That is also based on judgments technically. At the end of the day, there is no, even though intangible asset, there is IAS 38 for that intangible asset, and there is IAS 36 impairment of assets to determine the impairment value. Most of these things are done by the judgment of management. Then long-term contracts. How we deal with it, it is not covered by any standard. It is not covered in the conceptual framework. For that reason, management is going to be establishing a lot of judgments in the determination of, say, the percentage of completion, how much revenue can be recognized. Then on certain tax positions, that one also management is going to be making judgment. Again, there are some guidelines under IAS 12, income taxes, when we are determining the deferred tax asset, deferred tax liabilities of an entity. But that is not enough to help companies to reach a conclusion. So a lot of judgments will be coming in when we are determining the deferred tax assets and the deferred tax liabilities of the company. All these are referred to as changes in accounting estimates. Now, the takeaway. The takeaway here is that where there is a change in accounting policy, where there is a change in accounting estimates, so where there is a change in accounting estimates, it is applied prospectively. Where there is change in accounting estimates, it is applied prospectively, meaning it affects current financial statements and future financial statements. We don't go back. What does that mean? So let's say that last year, 2020, we did provision for bad debt 5%. Then this year, 2021, our current year, we say provision for bad debt should be 15%. Do we go and reverse the records in the previous year financial statements? Hell no, we cannot go back and reverse the records in the previous year financial statement. All we can do is we're going to be applying it for the current year and go away. So where there is a change in accounting estimate, we don't do retrospective application. We do solely prospective application. So for instance, depreciation method is changing. That is a change in accounting estimate. We don't do retrospective application. The economic useful life of an asset is changing. We don't do retrospective application. We do prospective application. You don't go back and readjust the financial statement because these are changes in accounting estimates. So when we talk about accounting policies, changes in accounting estimates, and errors, these are the things we are talking about. Any questions for me real quick on this one? Any questions for me on this one? I'm seeing some charts coming in. Let's see if I can take them. Any questions for me on this one quickly? So remember the takeaway that we have in that a change in accounting policy should be prospective. A change in accounting estimate should be, change in accounting policy should be retrospective. Change in accounting estimate should be prospective. However, you must be mindful of how you're going to be applying it and know the examples of each of them. Samuel Trust said, love from Nigeria. Okay, love you too, Niger people. I think Nigeria is, I think the second top countries that we get views from. So, hey, more love to you guys there. Emmanuel Esil, what? Is that Esilfi or what? Esilfi. Forgive me if I don't mention your name right, okay, Emmanuel. God bless you, Nhyira. As your name says, you are blessed already. Yep, I'm blessed already, you see. God bless you too, Emmanuel. Joseph Odek said, good job. Thank you, Joseph. I hope you're enjoying the stream. Any other questions for me, please? Any other questions for me? That is the issue about IAS 8, accounting policies, changes in accounting estimates, and errors. Accounting policies, changes in accounting estimates, and errors. Any questions? As we switch over to IAS 16, property, plant, and equipment. Property, plants, and equipment. Any questions for me, please? Any questions? Okay. So when it comes to dealing with non-current assets broadly, we can categorize them into two. There are certain non-current assets that an entity uses for the day-to-day running of the organization. It could be an asset that an entity is using as administration block. It could be an asset that an entity is using as a warehouse. That's a building. Or it could be used as whatever. Let's say a showroom. Or they are using the assets in the day-to-day running of the organization, in their manufacturing, whatever, plants or facility. So as far as the asset is used for the day-to-day running of the organization, these assets are referred to as owner-occupied non-current assets. Okay, owner-occupied non-current assets. And because they are owner-occupied, the entity that controls it is using it for the day-to-day running of the organization. We're going to be accounting for such assets under IAS 16, property, plants, and equipment. Under IAS 16, property, plants, and equipment. But then there are certain assets that an entity is not using for day-to-day running. The entity is not using it as a warehouse. It's not part of its manufacturing facility. It is not using it as a showroom, but maybe the entity is holding on the asset and earning rental income from it. Or the entity is undecisive on what to use the asset for. In other words, the entity is undecided on the purpose or usage of the assets. What it means is that such assets are being held for capital appreciation. So the assets are being held for capital appreciation. So if we have an asset that's being held for capital appreciation, or the asset that the entity is renting out on an operating lease to others and getting rental income, then those assets are going to be classified as non-owner occupied assets. Okay, non-owner occupied non-current assets. Now, since they are non-owner occupied non-current assets, what's going to be happening is that we are going to be accounting for such assets in accordance with IAS 40 as an investment property. Are you getting the picture? So broadly, we must understand the purpose of the assets. Is it being used as the day-to-day running of the organization, or for the day-to-day running of the organization? If yes, then it's an owner-occupied asset. We account for it in accordance with IAS 16, property, plants, and equipment. But then if that particular asset is held for capital appreciation purposes, or the entity is undecisive on what to use the asset for, then it is going to be accounted for in accordance with IAS 40, property, plants, and equipment. Okay? Did I say property, plant, and equipment? Investment property. Okay? Investment property. So how do we account for it? Our discussion is, for the time being, going to be based on IAS 16, property, plants, and equipment. IAS 16, property, plants, and equipment. So when we talk about IAS 16, we are saying that the objective of the standard is to prescribe the accounting treatment for owner-occupied non-current assets. The accounting treatment for owner-occupied non-current assets. We want to find out, how do we treat owner-occupied non-current assets? Now, this is a beautiful standard. Like I said, I call it the grandpapa of all standards, because, I mean, this is where it all starts. This is the foundation. If you screw this standard up, I bet you're going to screw a lot of standards up, because of how basic this standard actually is in that manner. So when we talk about IAS 16, property, plant, and equipment, a number of things must be understood off the bat, and that is the recognition criteria of property, plant, and equipment. When can an item be categorized as a property, plant, and equipment? At what point can an entity say, hey, we want to classify this property as, or we want to classify this asset as part of our property, plant, and equipment? When can the entity say that? Number one, so the recognition criteria. Number one, it should meet the definition of property, plant, and equipment. So it meets the definition of property, plant, and equipment. Now, let me say this. The recognition criteria of PPE, property, plant, and equipment, is going to be similar to IAS 40, investment property, and similar to IAS 38, intangible assets. So when you get to intangible assets and you get to IAS 40, you don't have to think again about their recognition criteria. It is the same thing here. Just going to be flexed a little bit. So it meets the definition of a PPE. Number two, the cost can reliably be measured. The cost can reliably be measured. Meaning that we can measure the cost that we are incurring. And we're going to be looking at that in a moment. We can measure the cost that we're going to be incurring. And then number three, it is probable that future economic benefits from the asset will flow to the entity. From the assets will flow to the entity. So these are the three recognition criteria, or this is what we call the recognition criteria for PPE. Okay, it meets the definition of an asset, that is a property, plant, and equipment. The cost can reliably be measured, very, very important, and it is probable, meaning that the cash benefits, the service potential in the assets will significantly flow to the entity. That is the recognition criteria for intangible assets. Why am I saying intangible assets? For tangible assets, okay? For tangible non-current assets, PPE. For tangible non-current assets, PPE. Okay. So once we have this, we need to look at the measurement of PPEs. Measurement of PPE is divided broadly into two, and we have what we call the initial measurement of PPEs and subsequent measurement. So initial measurement of PPEs and subsequent measurement of PPEs. Because for the first time, how do we measure it? And after that, how do we measure it again? And for time being, for the purpose of time constraints, I'm going to be concluding around here today, so that, God willing, next week, we're going to be continuing with this discussion on the IAS 16, property, plant, and equipment. The key takeaway here is that the objective of the standard is to prescribe the accounting treatment for owner-occupied non-current assets, and the recognition criteria is that it must meet the definition of a property, plant, and equipment. The cost should be reliably measured, definitely. And then number three, it is probable that the future economic benefits from the usage of the asset will flow significantly to the entity. Once we understand this, then we now come to the place where the examiner is going to start to get us the initial measurement and the subsequent measurement. Any questions for me, please? Any questions for me? If there are any questions, put it in the chat. Let me see if we can address them real quick. Now, remember that you can get the audio lectures or audio content on each podcast platform that you are on: Spotify, Apple Podcast, Google Podcast, wherever you get your podcast from. Just search for Nhyira Premium. I'm going to be there, definitely. And you can get the audio lectures and be listening to these things over and over again, because they will help you to really pass the examination. Science has proven that if you engage more than one sense in learning something, it increases your chances of passing, understand or comprehending and remembering what you are studying. So, I mean, you listen, you watch. These are all different senses. These are all different environments, and it helps you to better understand and pass the exams. Amadou said, today I missed a lot. So many distractions. Oh, no, don't worry. You can always watch the playback, because it's definitely going to be available on YouTube here. And the audio will also be available on our podcast, the Nhyira Premium podcast, that you can get on all podcast streaming platforms there. Tadese, forgive me if I'm not able to mention your name well, okay? But Tadese said, hi there, any online training lecture what is the YouTube hours for non-fee paying students? It's 4:30 p.m. GMT on weekdays. Hopefully, you can follow me on Instagram, and the details of whatever discussion we're going to have for a day is going to be posted on my Instagram page. So you can follow me on Instagram, Nhyira Premium, the same name, but it is 4:30 p.m. GMT weekdays. Okay. Tadese, you're asking any online training? Yes, there are. You can visit our website. The first link in the description of this video, it's our website. Or you can send us hi on WhatsApp for whatever details that you have, and it could be looked at for you. I want to bring, this is our number. You can send hi on WhatsApp on this number, 05011499296. If you're outside Ghana, the country code is +233. And you send hi on WhatsApp, and we will be able to answer any questions that you may be having. And you can enroll in our programs as well there. Bruce Apore, hey, don't fret. Forgive me if I'm not able to mention your name right, okay? Just forgive me. God richly bless you, sir. God bless you too, Bruce, for joining us. It's always a pleasure coming your way and assisting you to prepare for your examination. Okay, so that is it. It's been a great week as we really begin this journey. And we have about 9 weeks to go for the ICA April 2022 examination. So I will encourage you to really start studying very well. You can check the playlist on the channel. We have a lot of videos on a lot of subjects, a lot of topics on the channel that you can get access to. And in case you want to also get access to me fully to study directly under my mentorship, you can enroll in our full course. It is 390 Ghana cedis per paper. Or better still, if you are someone who is busy, who cannot fit into the regular, then maybe you could request a private class, and that starts at 2,500 Ghana cedis per paper. And you have to make an inquiry about it to see whether we have any slot available for that. So these are the 3 ways you can get me up at the end of the day. You catch me on YouTube for free. You catch me on Zoom at 390 Ghana cedis, or you can catch me at a premium level for 2,500 Ghana cedis as a starting price also there. So thanks very much. You guys, really love you. And thank you for those of you who have been sharing our videos, and those of you who have been giving us the thumbs up and the support and the comments. Really appreciate it. God bless you. And I'll catch you same time next week as we continue with our discussion. So have a great weekend and stay blessed. Bye-bye.